The camera opens with a quiet sunrise over a modern American city. The streets glisten with the reflection of tall glass towers, and the hum of a new day begins. In this stillness, a question echoes in the mind of every working individual. How can one truly achieve financial independence without relying on unstable shortcuts or excessive risk? The journey toward financial independence begins with understanding one simple principle: growth through assets. Assets are not just possessions. They are tools that work quietly in the background. While a person focuses on building a meaningful life, every financially secure person, from entrepreneurs to middle-income professionals, shares one foundation: they own or invest in appreciating assets. True independence is not about having millions in the bank. It is about building a system where money consistently grows without direct effort. Every day, this system begins with the mindset that money is a worker, not a master. When guided correctly, it multiplies through discipline, patience, and the right knowledge. The path to asset growth begins with clarity. One must first define personal goals, not just vague dreams, but measurable financial milestones. A person might say, "I want to be independent," but independence requires structure. It involves creating a map with specific checkpoints, emergency savings, long-term investments, debt management, and diversified income sources. In the United States, this roadmap has a clear direction. Start with what is controllable. The average working individual can build a strong base by focusing on three key pillars: controlled spending, consistent saving, and strategic asset accumulation. The first pillar, controlled spending, may sound simple, but it is the foundation of every financial success story. Overspending is the invisible force that destroys wealth before it even begins to grow. Financial independence starts by assigning every dollar a purpose. When unnecessary expenses are reduced, more capital becomes available for investments that can grow. The second pillar, consistent saving, transforms stability into opportunity. Savings are not just funds stored for emergencies. They are the first building blocks of freedom. When an individual sets aside even a small percentage of income every month, it develops a rhythm, a steady pulse that prepares the ground for asset growth. The third pillar, strategic accumulation, is where independence begins to take shape. Accumulation does not mean collecting items. It means acquiring income-producing or value-appreciating assets. This may include stocks, real estate, business ownership, or government-backed securities. The purpose is not to gamble with money, but to position it where it can steadily increase in value. Financial independence is not achieved through luck. It comes through knowledge-based decisions. When one studies the movement of the economy, the trends of different sectors, and the behavior of assets under various conditions, they no longer depend on chance. They rely on understanding. Asset growth is not only about financial return, it is also about protection. Inflation quietly erodes the value of cash over time. Assets such as real estate or equity tend to grow with or above inflation, acting as shields that preserve the power of wealth. For someone starting today, the journey should begin with simplicity. Open a savings account dedicated solely to investments. Automate a portion of income to flow there every month. Once stability is established, consider diversified options, low-risk index funds, dividend-yielding stocks, or fractional real estate platforms available in the USA. The most powerful tool in this journey is consistency. Small, disciplined contributions made regularly have more power than large, irregular investments. Compound growth transforms steady effort into exponential results. A modest contribution today can grow into something significant over the years because every bit of profit reinvested adds a new layer of growth. The beauty of asset-based independence lies in freedom of time. When assets produce income, individuals regain control of their lives. Instead of constantly working for money, money begins to work for them. This shift in dynamic changes not just finances, but life itself, allowing time for family, creativity, and contribution to society. There is no need to chase quick wealth schemes or speculative trends. True prosperity thrives on patience and clear principles. In every market correction or economic fluctuation, well-chosen assets continue to recover and grow. The modern world rewards those who understand value creation, whether it is through investing in productive companies, real estate developments, or digital platforms that generate steady returns. Each decision built on real value moves one step closer to independence. Financial freedom is not a myth. It is a carefully structured result of knowledge, discipline, and time. Every successful individual who has reached it followed the same truth. They grew their wealth through assets, not through chance. Your path to financial independence begins the moment you decide to make money your partner, not your controller. The sunrise that began this story represents more than a new day. It represents opportunity, the chance to take control of the future, one disciplined decision at a time. The next phase in the path to financial independence through asset growth is strategic expansion. Once the foundation is stable, the goal shifts from simply saving to multiplying. The true art of wealth building lies in creating systems that grow without constant supervision. In this phase, one learns to think like an investor, not just a saver. An investor observes the movement of money in the economy, studies trends, and identifies where value is being created. The American financial system offers countless legitimate pathways for asset growth, but not every option is suitable for everyone. Understanding one's risk tolerance and long-term goals is essential. Let us explore how this path develops. It starts with diversification, the principle of spreading assets across multiple areas to reduce risk. For example, someone may divide their investment portfolio among real estate and small business equity. Each of these grows differently under various market conditions. When one slows down, another often grows, keeping overall performance stable. In the United States, real estate continues to be one of the strongest long-term asset classes. It offers both capital appreciation and rental income. A well-chosen property, even a small one, can become a silent partner that pays every month while increasing in value over time. Property investment also provides tangible security, a physical foundation that does not vanish with digital fluctuations. Equities, or company shares, represent another powerful vehicle for growth. By investing in well-established companies with strong financial health and consistent performance, investors participate in national and global progress. Index funds allow individuals to own small portions of many companies, balancing risk and reward effectively. Dividend-paying stocks offer additional stability. They not only grow in value, but also distribute regular income, which can be reinvested or used as passive cash flow. Over time, these dividends, when reinvested, accelerate compounding, building serious wealth quietly and consistently. Another form of asset growth lies in entrepreneurship. Owning or co-owning a business that solves real problems provides both control and growth potential. Unlike speculation, productive businesses are rooted in value creation. Even small digital or service-based ventures can become strong income generators if structured efficiently and ethically. One often overlooked aspect of financial independence is asset protection. Growth alone is not enough. Security is vital. Insurance, legal structuring, and debt management safeguard progress. Without protection, one market downturn or unexpected event can disrupt years of effort. Setting up emergency reserves and ensuring proper coverage transforms growth into long-term resilience. Technology has revolutionized how assets are managed. In the USA, platforms that track net worth, automate investments, and provide real-time analysis have simplified the process. Yet, technology remains a tool, not a replacement for wisdom. Human judgment, guided by knowledge, determines true success. Another key factor in achieving independence is behavioral discipline. Many lose potential wealth not because of bad investments, but because of emotional reactions. Panic during downturns or greed during market highs destroys balance. The best investors are those who remain steady, viewing every movement as part of a larger cycle. Asset growth also involves reinvestment. When profits are withdrawn prematurely, compounding breaks. The goal should be long-term expansion, not short-term satisfaction. Each reinvested dollar becomes a worker, producing more income and contributing to exponential growth. A practical example, imagine a person investing $500 per month into diversified index funds that yield an average of 8% annually. Over 10 years, that consistent action grows into more than $90,000, with a large portion coming purely from compounded gains. The lesson is simple. Discipline outperforms luck. Another critical step in this journey is continuous learning. The financial landscape changes. Frequently, regulations, technology, and markets evolve. Those who keep learning remain adaptable. Reading financial reports, following credible economic news, and studying investment strategies sharpen decision-making power. Lifestyle also influences independence. The more one aligns daily habits with long-term goals, the faster progress becomes visible. Avoiding unnecessary debt, prioritizing essential purchases, and valuing time as much as money lead to balanced prosperity. Financial independence does not mean isolation. Collaboration often accelerates growth. Networking with like-minded individuals, joining ethical investment communities, or consulting professional advisors adds perspective and reduces mistakes. When assets start producing consistent income, the next step is optimization, refining systems to enhance returns without increasing risk. This includes rebalancing portfolios, reducing costs, and shifting investments towards stronger performing areas. Generational planning forms the final layer of independence. Wealth that stops with one person is temporary. When structured properly, assets can support families for decades. Trusts, education funds, and sustainable business structures transform financial independence into a legacy. The emotional side of independence is equally significant. The peace that comes with knowing one's future is secure cannot be measured in numbers. It allows freedom of thought, creativity, and contribution. With financial pressure removed, people find more time for innovation, community, and personal development. In the grand picture, asset growth is not just an economic process. It is a reflection of responsibility. Each decision to save, invest, and protect contributes to stability, not just personal, but societal. When individuals manage resources wisely, entire communities grow stronger. Financial independence through asset growth is a disciplined art, built on patience, wisdom, and balance. The cinematic city that began this journey now glows under the evening sun. People walk confidently, not burdened by financial stress, but guided by clarity and purpose. This is not the story of one person. It is the path open to anyone willing to learn and act. The tools exist. The systems are accessible. The difference lies in decision and discipline. Every sunrise represents another opportunity to grow, to build, to own, and to create a secure tomorrow through steady, halal, and responsible asset growth.